Hey, this is Sam Sawhook, one of the co-founders of Nth Venture, and I want to give you some insight into what in the world is cohort commissioning. What is this crazy thing that these kids are doing? Pretty exciting stuff in terms of the way that we're able to structure this because we're not a venture capital fund, we're not an accelerator, not an incubator. These things are coming straight from us from day zero. It allows us to do some really interesting things in terms of efficiency, also in terms of investor returns, not only on the return side though, in terms of control. Shareholders can own these things directly, but still have diversified interest and get in before there's even a founder. So it's a really interesting process and has, so far been really interesting for all parties involved. And I'm going to tell you a little bit more about how it works. So, basics of a studio. What we do at Nth is bring together the team, the idea or business model, the cash, and the support that they need to get off the ground. From an administrative perspective, legal is all kinds of different things in terms of having access to the right networks, etc. But when it comes to the blocking and tackling, a lot of these early things, it's a lot easier to do the hundredth time than the first time, and the cost structure gets greatly reduced. Bringing on obviously the right people is huge. Having the right model that can work not only at the early days but has something to it that allows it to scale and be interesting from a long-term value perspective, and having access to funding and being able to cover those early expenses. So all of that comes together into a really strong startup. And that's what we do on a daily basis. Now, we used to do these one off, we'd build them concurrently, but they would be staggered. Now, what we do is put a new cohort together and go out and build these at the similar time, kind of like mechanizing the process. So everybody's doing their marketing plan at the same time. Everybody's kind of doing the same things at the same time. That allows us to get a lot of efficiency, but also cross pollination on the specific things that they're doing at that time. So this would be a cohort. Now, what does that actually look like in terms of launch process? So it takes us 6 months, is what we generally look at here for the launch process, and that starts with hiring a president and ends with placing their fully fledged board of directors with a business that's operating. So before that, there's a lot of due diligence and prep work that we need to do before these things get off the ground, and we'll also do the cohort commissioning process, kind of across both the early stage due diligence prep cycle. Once we place the initial team, it will continue in here. So this part is where we're doing the recruiting of the president advisory board, placing that senior staff. Then we'll have them put together a very detailed strategy that they present to our board and their board, and articulates everything under the sun that they're going to need to do, and make sure they have the resources available to do that. Then they start building, and eventually we'll hit their go-to-market about here. And once they do their go to market, then we'll kind of come back in the shop and be like, hey, how's it going? What needs to be improved or changed? What can we lean into? How can we be educated by the punch in the face by the market? And then we'll relaunch out there and make sure that they've got everything they need for the long run. And then we'll have a first annual shareholders meeting to place their board of directors. So they'll have an independent governance structure and ready for the long haul. So that's the general launch procedure. Takes 6 months once we bring on the first person, and there's some prep work ahead of that. And that's generally from a super high level. Those are the main components of it. So what does the cap table look like? Who's getting what? So at the beginning, since we're the one incorporating these, we authorize 100 million shares, and Nth will take 30 of that, and then we turn right back around and sell those to the cohort sponsors. So then each one of these is at 15 while the remainder of this is not allocated. So it's been authorized but hasn't been allocated or is not currently outstanding. So in reality, we're more like 50-50 owners here. And then at full maturity, so we'll have that same split here, those 15 and 15. Then we authorize 20 million of treasury shares. So if you're not familiar with those are basically shares that are owned by the company itself that are used in a sale transaction for investors. So we're basically planning against when they're doing maybe a seed round or an A round, or maybe they're doing so well organically that they're doing acquisitions. But this is basically set aside for investors that are later on. So we can do that without experiencing dilution. And then the remainder of this is 50 million that are allocated to the equity incentive plan. That allows us to bring on the advisors, the presidents, all the senior staff. And if you want more info on this, we have other resources on that. But there's basically RSUs are shares that have a 10-year vesting schedule. So it's a while before all of this gets actually diluted down, but that's what we have planned for the long term. Okay, so how does this come into play for the valuation? So this is a typical company that we built, one of the cohorts. So we sell shares at a penny per share. And if you remember from the last slide, there's 30 million that are currently outstanding at the beginning. So we're talking about a 300K valuation. Now, if you're a startup person and you're drinking coffee, you probably just spit up all over your computer because you realize how low of a valuation that is for a startup. That's by design. We're going for extraordinary returns here, people. I'm an investor in this stuff too. So there's on a typical startup, the market for that is anywhere between 6 and 20 million. We're able to get in at 300K. So this is the real juice here for a lot of this stuff. But there's a lot of other benefits. So if you're familiar with what OSAM, O'Shaughnessy Asset Management, was able to do via direct indexing, there's very similar effects in terms of you have direct equity interest in each one of these things. And that allows folks to get access to some of the tax loss harvesting benefits, but also in terms of shareholder rights, you can exit when it makes sense for you, not when your GP mandates it. And because of that, there's no fees, there's no middleman, there's no fund. You own the shares in these companies directly. But because of our cohort process, you get immediate diversification while retaining passive interest, shareholder rights, the low valuations we talked about. And remember that the nth and the cohort sponsors have perfectly aligned incentives here in terms of the equity interest is very similar in terms of our incentive for the long term. So you know that you have a partner here that has the same skin in the game that you do. That's cohort commissioning. I'm sure there's a lot more questions. If you have any, feel free to reach out and join the resistance. Thanks, folks.